Many investors on YouTube talk about the best 3-fund or 4-fund portfolios. Most of them are not bad. The fundamentals of investing stay the same. Time in the market beats timing the market. Dollar cost averaging works, and investing consistently is key. But today I'm going to show you my version of the perfect 4-fund portfolio. And the fourth ETF in my portfolio, it's a fund that I don't see many people talking about yet. I believe it's a crucial asset class that brings real diversification. So stick around because you don't want to miss this. If you've read the book, The Boglehead's Guide to Investing, you know about the classic 3-fund portfolio, which includes a U.S. total stock market ETF, an international ETF, and a bond ETF. Can this portfolio work? Absolutely. If you're a hands-off investor who wants to check your portfolio maybe once or twice a year, it's a great approach. But if you want to be more engaged, take on slightly more risk, and optimize your portfolio for growth and dividends, a 4-fund portfolio can be a better fit. So today I'm going to break down my 4-fund portfolio, why I selected these ETFs, and how they work together to create a balanced, diversified, and high-performing investment strategy. The first and largest holding in my portfolio is VOO, the Vanguard S&P 500 ETF. This fund is the foundation of my investments, making up 45% of my portfolio. VOO tracks the S&P 500 index, giving exposure to 500 of the largest U.S. companies, which are some of the most dominant businesses in the world. VOO is the largest ETF in the world with $1.4 trillion in assets under management. In its 5-year performance, it's up 82%, and its 12-month performance, it is up 23%. And it has a very low expense ratio of just 0.03%, one of the lowest on the market. A major reason I love VOO is its market cap weighting. Larger companies like Apple, Microsoft, and Nvidia have the most influence, meaning VOO benefits from their explosive growth. Simply put, when you invest in VOO, most of your money goes to the biggest and best companies in the U.S. Next up, we have SCHD, the Schwab U.S. Dividend Equity ETF, making up about 30% of my portfolio. SCHD is my go-to ETF for dividends and stability. Unlike VOO, which focuses on market cap, SCHD targets high-quality dividend stocks with strong financials, consistent dividend growth, and solid cash flows. The current dividend yield is about 3.6%. The 5-year dividend growth rate is 12%. And total holdings, it has 100 plus high-quality dividend stocks. SCHD is an excellent complement to VOO. It gives me exposure to blue-chip dividend companies that offer income and growth without the extreme volatility of tech-heavy funds. While VOO and SCHD offer balance and dividends, I also want exposure to high-growth technology stocks. That's why I allocate 15% of my portfolio to QQQM, the Invesco NASDAQ 100 ETF. QQQM is a growth-focused ETF that tracks the NASDAQ 100 index, which includes 100 of the largest non-financial companies listed on the NASDAQ. Top holdings include tech giants like Apple, Microsoft, Nvidia, and Meta. About 50% of the sector exposure is in technology, and the 5-year performance, this fund is up 85%, has an expense ratio of 0.15%. QQQM is heavily weighted toward tech stocks, making it more volatile, but also a powerful driver of long-term returns. When the tech sector booms, QQQM delivers. It's a great fund for investors looking to capture high-growth innovation and future market leaders. And now for the fourth and final ETF, which is VNQ, the Vanguard Real Estate ETF. Many investors completely ignore real estate in their portfolios, which I think is a mistake. VNQ provides exposure to the real estate sector through REITs, which are real estate investment trusts, allowing you to invest in real estate without the hassle of owning physical properties. The current dividend yield is about 4%. The sector focus is on commercial and residential real estate, data centers, and healthcare properties. VNQ is down 5.17% over the past 5 years, largely due to high interest rates, which have hurt the real estate sector. However, if rates decline in the coming years, VNQ is expected to rebound as lower borrowing costs typically boost real estate investments. With a low 0.13% expense ratio, VNQ remains a strong option for diversification and long-term income generation. REITs have historically been a great inflation hedge and provide diversification since they don't move in lockstep with the stock market. While VNQ won't outperform tech stocks, it adds stability, cash flow, and long-term appreciation. That's why it makes up about 10% of my portfolio. So let's recap my perfect 4-fund portfolio. I have 45% in VOO for broad market exposure and long-term growth, 30% in SCHD for dividend income and stability, 15% in QQQM, offering high growth tech exposure, and 10% in VNQ, which gives me exposure to real estate and as an inflation hedge. This portfolio is diversified across different asset classes and designed to balance growth, income, and stability. Young investors might want a higher percentage in QQQM for more aggressive growth. Retirees may prefer more SCHD and VNQ for steady dividends and lower volatility. Balanced investors can keep this allocation as a well-rounded, diversified portfolio. Ultimately, your ideal allocation depends on your goals, risk tolerance, and time horizon, But this 4-fund portfolio provides broad exposure, strong dividends, and long-term potential. So what do you think of my perfect 4-fund portfolio? Would you change any of these ETFs? Let me know in the comments. I really appreciate you watching. If you're not sure what to watch next, check out another one of my videos right here. I think you'll really enjoy. Take care, and I'll see you next time.